So let's talk about now the statistical concepts behind probability distributions and the simplification that we've introduced with event trees. Since we don't know the future returns, we have to make these educated guesses about the probability distribution. We have to, if we can, maybe simplify using this event tree approach. But to take a step back, let's just think about what a random variable is and what we can know about it. Any random variable, as we saw with returns in the prior examples, has a range. Returns range from negative 100% to positive infinity. And the trickier part is a probability distribution. Prices, remember, have a range of 0 to also positive infinity, and presumably a different probability distribution from returns. So let's think about a certain random variable. It's got some probability distribution of it taking on values of, let's say, -1, 0, and 1. The probabilities have to sum up to 1, of course. The range of the possible values will really depend on what specifically we're trying to model. So for a price, the range will be 0 to infinity. And so we can then think of all of the possible realizations as essentially a vector, the values of the price. And each element of that vector will be accompanied by a certain probability. So in the previous section, we talked about how we can take this sort of general probability distribution that is a continuous function. Remember, not all probability distributions are bell-shaped. You could have a bimodal one that actually has 2 humps. You could have something with maybe an asymmetry. You could have a skewed probability distribution, but it's some sort of function. And we talked about how we can simplify these functions into event trees. But however we've done it, when we then begin to talk about these payoffs, random variable payoff or return for portfolios, we really want to calculate some summary statistics like we did in the example a little bit ago to more easily compare portfolios one to the other than to look at literally all of the possible payoffs in a continuous function, which is, of course, in infinity, or a smaller but still somewhat cumbersome discretization using an event tree. So if we can boil them down to a couple numbers, that would be ideal. And as we saw with the continuum of riskiest to least risky portfolios in our prior discussion, the mean and standard deviation are pretty good candidates for boiling down the risk-reward profile of any portfolio. So let's talk in a bit more depth about these. Really, the primary things that you need to think about as a portfolio manager or an investor are the expectation or mean return or payoff to your portfolio, the variance or standard deviation of that portfolio, that would be our risk measure, the covariance of the portfolio with other portfolios or of assets within the portfolio, and its cousin, correlation. Now, that's not to say that that is all there is to statistical measures relevant for investments. People do pay a lot of attention to skewness, the asymmetry of the distribution, to kurtosis, the fat-tailed nature of the distribution, which is to say how likely rare events are and whether they actually are rare or perhaps less so. But these are the big ones. So let's go through them one by one. The expected value or the mean is really the simplest one. All you do is just take a probability weighted sum. You have your vector of outcomes x, you have your vector of probabilities p, you multiply all the elements and add them up, and that essentially tells us what the most likely outcome there is. And then this actually generalizes, so if we can get the expected value for each asset, we can then get the expected value of each of the portfolio of those assets by multiplying those respective expected values by their weights in the portfolio, as we did with the example of a bond and a stock in the prior discussion. So let's say that we've got our example of a random variable that can take on three values, -1, 0, and 1. Let's say the probabilities of those are 30, 50, and 20% respectively. Those probabilities add up to 1. What is the expected value of this variable? Well, remember, it's just this probability weighted sum. So we take our -1 realization, that has a 30% chance happening, we multiply those two together. The 0 realization has a 50% chance happening, we multiply those two together. And the 1 realization has a 20% chance happening, multiply those, add all three up, and we get a -0.17 expected value. So the most likely outcome, of course, of these three discrete events is that x comes out to be 0. So the expected value being close to 0 shouldn't surprise us. But this is just the expectation. What we would also like to know is how uncertain we are in this expectation. In other words, how variable these outcomes might be. So for this, we're going to need another idea of dispersion. And we'll talk about either standard deviation or its square, the variance. So the variance is the probability weighted sum of square deviations from the mean. Remember, we already calculated this quantity, E of x. That's the probability weighted sum of realizations, the expected value. If we now, for each observation, subtract the mean, square it, and then get the expected value of that, in other words, another probability weighted sum, that'll tell us how variable our individual observations are. And if we take the square root of it, that will give us the standard deviation. So in a way, this sort of tells us how different our possible future realizations can actually be from the mean. Now, this will be sort of our main measure of risk. How different you could come out from what you might generally expect. You can see two time series here. The low variance one doesn't bounce around from its expected value near 0 too much. The high variance one, you can see, bounces around quite a bit. So even if both of these have the same mean, you can just by inspection tell which one of them is going to have the high variance, the one that makes these big deviations from the mean. And since generally we suppose that most investors are risk averse, that means that they will actually want a reward or compensation for risk. Just as the yield on bonds with higher credit risk is generally higher, so is the return on any greater risk asset generally greater. Which means that you can either have an asset with high risk sold at a low price today, or, and I suppose as a consequence of that, it achieving a much higher price in the future. So if an asset is high risk, we should expect it to have high expected returns, simply because that's what it would take for somebody to actually want to hold it. Now, mean and variance are all well and good, but covariance is actually potentially also very interesting. What this does is it tells us the relationship between two random variables. And it might seem a bit puzzling at first, but if you think about a portfolio as sort of a combination of assets, then it starts to get real interesting real fast, because really then what we care about is how the assets in our portfolio move together, since the payoff is going to be this joint payoff of all of them. So mathematically, what covariance asks or tells you is, let's say random variable x is above mean, how likely is random variable y to be above mean as well? If it's more likely than not, then there is a positive covariance, and as we'll see, a positive correlation. How do we calculate the covariance? We can represent it using this notation cov as a function of two variables x and y, or we can use Greek letters to denote it as sigma sub x and y. Well, if a variance was the squared deviations from the mean of one variable, covariance is the product of deviations from the mean of two variables. So here's the deviation of variable y, here's the deviation of variable x. We take the expectation of that, in other words, another probability-weighted sum, and that is our covariance. And since these differences are now signed, that means that each time we have x above its mean and y above its mean, that boosts covariance. Each time x is below its mean and y is below its mean, it again boosts it, because negative times negative is positive. And each time they mismatch, one is above, one is below, that lowers it. So covariance tells us essentially whether two returns or prices move together. And if they do, they have positive covariance, and if they don't, they have negative covariance. Of course, we should also consider that it's possible for two assets to be completely uncorrelated, in which case their covariance is 0. So in the plot on our left here, we see two assets that are positively covaried. In other words, they generally move in the same direction. And on the plot on the right here, we've got assets that are negatively covaried. They generally seem to move opposite one another. So we briefly mentioned correlation, but now let's actually see how it relates to covariance. It's essentially a normalized version of it. And what effectively it does is it transforms it to a variable bound between -1 and 1. And all we do to get this correlation is just take our covariance and divide it by both standard deviations of the two random variables. So by looking at this transformed value, you can sort of get us a very quick and, more importantly, comparable indication of how strong the relation between any two random variables is. For example, if the correlation is 1, that means that two variables are perfectly positively correlated. Each time one goes up, the other goes up as well. If the correlation is -1, they are perfectly negatively correlated. If one goes up, the other always goes down. And if there is no correlation, then the correlation, of course, by definition, is then 0. And generally, then, the closer it is to 1, the more variables move together. The closer it is to -1, the more they move opposite to each other. But that should not be interpreted as to say that they aren't related. In other words, a negative correlation doesn't mean that two variables have nothing to do with each other. They, in fact, are very entangled. They just move in opposite directions. If they had no relation, then the correlation would be 0. So let's go through an example of some of these basic statistics for a simple asset represented as one of these event trees. Let's say each of the events has a 1/3 likelihood of happening. The payoff to this asset If, let's say, a good outcome happens, it's 6%, if a neutral, 0, and if a bad one, -3. Let's compute first the mean and the variance of this asset. Well, what's the mean? Remember, probability weighted sum. So 1/3 times 6, 1/3 times 0, 1/3 times -3. The average payoff is 1%. What is the variance? Well, for this we're going to need the mean, in other words, another probability weighted sum, of squared deviations. So first let's compute these deviations from the mean. The mean is 1, so in the first case, if we have a good outcome, the deviation is 6% minus 1%, 5%. If we have a middling one, deviation is 0 minus 1 or -1%. And if we have a bad outcome, the deviation is -3 minus 1, -4%. Now, we actually don't want these to be signs, so we're going to square them to capture their overall magnitude and emphasize bigger outliers. So 5 squared is 25, 1 squared is 1, -4 squared is 16. And if we then take the probability weighted sum of these three, we get 14. And then the standard deviation is the square root of variance, or 3.7%.